There's no doubt Scotland, with a population of over 5 million and an abundance of natural resources, could make a viable country. The Scottish Government claims an independent Scotland could be the 14th wealthiest nation in the world when its economic output is divided by the number of people in the country. This puts Scotland ahead of the existing United Kingdom, although it's based on contentious estimates for the output from North Sea oil. However, the upset we've seen on markets, with the pound and Scottish stocks plunging after polls showed a swing towards a yes vote, underlines the risks that a breakup of the 307-year-old union poses Scotland and the rest of the UK. Markets hate uncertainty, and unfortunately a Scotch mist has descended over the crucial question of what currency Scotland uses. Scotland's First Minister, Alex Salmond, wants an independent Scotland to share the pound because he wants to avoid the costs and hassle people and businesses would face from a new currency. He also doesn't want to alarm Scottish savers and pensioners whose money would probably fall in value, at least in the first years of a new currency. But UK politicians have refused to consider a currency union with Scotland. They remember the 2011 Eurozone crisis and the dangers of having a single currency across economies that aren't fully integrated. Besides, Mark Carney, Governor of the Bank of England, has firmly stated that a currency union is incompatible with sovereignty. If Scotland shared the pound, it would have to follow the monetary policy of the Bank of England, which would undermine the very independence that Scotland's First Minister and his Scottish National Party craves. Of course, Scotland could ignore the bank and carry on using the pound anyway, or it could launch a new currency pegged to the pound in much the same way as Hong Kong tracks the US dollar or Danish kroner follows the euro. But Scotland would need its own central bank, an equivalent to the Bank of England. This would need its own reserves, substantially more than the £15 billion Carney estimates an independent Scotland might start with. This is because Scotland's banking sector is 12 times the size of its economy, far more than it can safely support. The prospect of losing the protection of the Bank of England is why we've seen Scottish banks say they'd move their legal headquarters south of the border. They're responding to fears of a capital flight if people withdraw their money out of banks in Scotland. There's no need for people to do that because there'll be a transition period of 18 months before Scotland gains independence after a yes vote. The issue of the reserves then raises the state of Scotland's finances. The only way for Scotland to boost its reserves would be to raise taxes or cut spending. It will probably need to do this anyway, as independent economists say the country spends more than it earns. The Institute for Fiscal Studies estimates Scotland has a long-term budget deficit of nearly 5%. The Scottish Government says this is ridiculous given the large reserves of oil and gas left in the North Sea. It forecasts revenues of £5.8 billion in 2014 and 15, rising to £8.3 billion the following year. The UK's Office for Budget Responsibility disagrees. It forecasts oil and gas revenues of just £4.7 billion this year, falling to £3.5 billion in 5 years. Where oil revenues go is critical for Scotland's future. As a new country, it would face higher interest rates as bond markets will perceive it as a higher risk borrower. This would make the cost of mortgages for home buyers more expensive. Scots have already been warned they face higher shopping and phone bills if utilities and retailers gradually raise prices north of a new international border. All of this sounds very negative. The Scottish Government argues that once it has control of all the economic levers, it can boost growth in a way a London administration never could, and that will balance the books. That remains to be seen. The fact is, independence might give Scots the freedom they want. It won't necessarily make them richer. And what about the rest of the UK? Freed of the Scots, the peoples of England, Wales and Northern Ireland would also face an uncertain future. Losing the bulk of the North Sea revenue, as is likely, would worsen the rest of the UK's finances. The current account deficit would widen and could cause a run on the pound. Experts expect the pound to fall sharply if we get a yes vote on the 18th of September. This would be good for exporters, but for everyone else, there's a risk of a sharp rise in interest rates, even though the Bank of England will want to put off the first increase in the cost of borrowing for a few months. The danger is that interest rates spike up if bond markets mark the UK down because of the political uncertainties that would follow a yes vote. The political fallout in the UK from this is huge. The Labour Party would be in an awkward position if it wins the next general election with a majority based on Scottish Labour MPs who are about to be scrapped. Alternatively, it could increase the chances of a Conservative government, possibly with a new leader, who, following a referendum, might take the UK out of the European Union, the country's single biggest export market. There's no doubt the stakes are very high.